Ever wonder what really happens behind the scenes in construction, real estate, and development? We pull back the curtain on the new home construction industry, the real estate market, and the trends shaping it all. Discover the stories, insights, and expertise behind the process of building a new home. Join us for Trust the Process podcast, and let's build something great together. Hello, and welcome back to Trust the Process podcast, where we talk about the real estate industry, new home construction, and everything in between. Today, we are going to dive into what's going on since our last update. So we did an update at the end of the year, starting into 2025, and now as we end out the first quarter of that,
believe it or not,
I wanted to do a bit of a wrap up, just kind of what's been happening.
A little temperature check.
Exactly.
Yeah.
I like it.
Yeah.
I like it. So lots to talk about. Not too much is changing too rapidly. We're not in a really volatile time frame right now in the housing industry, but enough is changing that it's worth discussing. And there are some new things have come up.
Yeah,
so
there's some fault lines.
Yeah. So if you want to jump in, let's just dive right into it.
I really wanted to talk about the real estate market as a whole.
Okay.
In terms of where we're at in the first quarter of 2025. Mm-hmm. Real estate market, just general resales, how it affects new construction. Mm-hmm. I want to talk about mortgages because that dovetails into that as well. And then I want to talk about home building and home builder sentiment and those types of things that are really kind of dominating the headlines right now. Mm-hmm. So
I like that, breaking it up into
I just parts. Think it's...
While they all work in unison, they are sort of
they're kind of their own thing.
Sure.
Yeah. So the housing market is, as you said, it's not very exciting. It's just not a tumultuous year. It's been stable for the last more or less 2.5 years, I would say. Probably, well, we're going up probably on 3 years. I think it really started to stabilize in middle of 2022, which is what the intention was, to get a lid on that runaway kind of price gains that we were seeing, and that worked. Thankfully, we've just gone into a prolonged period of very stable, healthy appreciation and a lot of other factors that are affecting the market, not necessarily price gains. So inventory obviously remains really constrained, and then mortgage rates. And I think that kind of those two things together have kind of honestly functioned as a backstop on what could have been some really marked softening in the market. So the high rates all through 23 and 24 and now into 25, we're still yet to see anything with a 5 handle. So we're right now sitting in the back half of March. We're sitting at in the high 6s still to this day. So we are probably going to land there. That being said, back to appreciation. I want to talk about mortgages separately, but JP Morgan's, at the end of 24, JP Morgan, Zillow, the consensus among kind of those economists and people that make their living, NAR, things like that, organizations like that, pretty much had a consensus that home appreciation was going to be around 3 to 4%, with the least, the most conservative estimates at 3 and the most aggressive at 4.
Okay.
But regardless, that's just about keeping up with inflation. So that indicates that it's a healthy, stable market. Your money is safe in real estate. If you pay cash for your home, not only are you living there, but the value of that home is going up with inflation. So your cash is not rotting in your house. Obviously, you're saving a bucket of money on rates if you're able to pay cash for a home and not have those finance charges. So money is safe in real estate. And with that, we're still seeing a lot of investor purchases. So we're closed out 24 with $1 billion in investor purchases in the greater Las Vegas market. As a whole, we're kind of leading the nation when it comes to investor purchases. Us in Denver and Phoenix, kind of those suburban sprawl where it's easier to buy a block of homes, maybe not on the same block, but a block of homes that are relatively easy to manage versus a more fragmented market on the East Coast where it's harder to manage, maybe a suburb that's 20 miles this way, 20 miles that way. So we're still leading the nation with investor purchases, and the nation is leading the world in the amount of investor purchases into single family residential. So that's yet another backstop, and I think that's putting a lot of upward pressure on that appreciation, and maybe that's getting us the 4 and 5% appreciation that we saw last year. I think it's those investor purchases, and they lean towards the entry level market.
And also thinking about buyer sentiment, as we talk obviously we're active in in the environment, so we're out talking to people all the time.
Right.
And the things that we're hearing and the sort of the thought that people are discussing isn't necessarily like they haven't gotten the word yet that numbers are stable and things are okay. I think the average buyer might still be a little leery or might still be confused about where the market is or how rates look or feel and whether or not now is a good time to buy. So some of these things, while yes, they're facts and we know that the big picture is happening, I don't know if that has trickled down into mainstream home buyers.
I agree. And I think people buy homes when it's right for them, not when it's right for the market. But everyone is an amateur economist when it comes to their home purchase. And I think that you're 100% correct in that they don't know how to feel about the interest rates. They don't know they don't even know what a 7% rate translates to in a payment.
What's the
they
number?
Don't realize
Yes,
that
it's true.
that is a huge, when most of your amortization on the front end is interest, 7% versus 3.5% is a doubling of your mortgage payment because so much of it is interest. So it is a really big deal. So I think the sentiment might be there. I think that the generation, I'm an older millennial, right? So my generation saw a lot of people get burned by owning real estate. We were coming of age when people were actively getting burned. And I know you're significantly younger than I am, but your generation
definitely
your generation was actively burned by that market. But the newer generation has only seen real estate be a good investment. And the younger millennials as well have only really see it be a good investment. Their parents didn't lose houses. They didn't lose houses. They're tired of paying landlord $2,800 a month for a 3-bedroom house or $2,600 for a 2-bedroom apartment or whatever it may be. So I think that we're at a point now, especially 3 years into these kind of elevated rates, where buyers just aren't going to put their life on hold anymore. And we've seen that in people that we've talked to. They're missing out on their life. They're missing out on their grandkids.
We just had a situation this week. We just met with potential buyers who or actually, the other end of it. But in any event, exactly.
But sellers in our brokerage business.
Yes, exactly that. They've kind of been holding on. They weren't sure what the market was going to do. And, it's hard to get the real story. You're getting pieces or parts of it, or your Aunt Jane has a story about when,
that's right.
So you're not really able to put all of the information together. But same thing. They've just had their life on hold. And finally they were,
we're going to go
meet with our grandbabies.
We're going to sell. And exactly. We're going to give up our 3% rate and we're going to.
So in real time, I see that. Those are the stories that we have been hearing. And now we're real time. It's happening to our own clients.
It is. So, I mean, I think imagine multiplying that times the entire U.S. People just aren't going to wait forever. They're not going to keep renting forever. They're not going to share a room with their siblings forever. They're going to start their own lives, right? And I think that's what we're seeing a lot of people come off the fence. So that's where I see 25 going. And I think that the first quarter has indicated that. I will say in terms of the overall real estate market, what are some bright spots for buyers is that inventory is up about 16% from last year, but that only translates to 3.5 months supply versus 3 months supply from this time last year. Jan and Feb 2024 versus now 2025, where we gained an extra 2 weeks worth of market.
Not a huge swing, but for those people that don't know what that means, that short inventory means it's still a seller's market. So buyers are at a disadvantage. And
still, we're getting, at least the trend is correcting a little bit. So thankfully, we're going in the right direction. Conventional wisdom was always 6 months supply was indicated.
Kind of like even keel.
Yeah, kind of even keel, anything more. But
I haven't been 6 months.
Since probably 2009, 2010 maybe. And a lot of that was shadow inventory that couldn't be bought and sold. It was on the market, but it was a short sale and it was really not true market, not true inventory. So I think what we're looking at is a steep imbalance. And we've talked about this in the past. There's not enough new home construction, and we'll get to that later. But there's not enough new home construction. All the new inventory is going to come from new construction. There's just too many people locked into their rates that, yes, people are not going to wait it out forever. But you're also only going to find the people that are truly motivated. They're motivated to sell and move out of state to be with their grandkids. They're motivated to sell and downsize because one of the spouses died and they literally can't maintain the house. But there's a lot of people, a lot of families that are bursting at the seams. And how badly do they really need that 5th bedroom, or can they make it work? So I think that's kind of what we are seeing. So I don't want to understate, I don't want to downplay that. It is putting downward pressure. No matter how long we wait and no matter how long rates are elevated, there's still going to be downward pressure versus 3% to 3%. and all you're doing is covering the cost of a more expensive home. Now you're more expensive home and you're seeing your rate double. Or if you're downsizing, your mortgage payment's staying the same because you bought half the home but had double the rate. So it's not enough motivation there.
Yeah.
So, besides major life events, death, divorce.
The Ds, what are the 5 Ds? Death, divorce. What are they?
Make up the other 3.
No, there are.
Are there 5 of them? Okay.
Yeah, there are 5. I'll get back to that. I think of it.
So those are the things that I think are going to require the moves. But other than that, it will have some real downward pressure. The job changes, things like that. There. So we're seeing a movement, but it's just it's nowhere near what it needs to be. So the bottom line is Q1 is a boring quarter. It's good.
Good thing.
You want boring.
Yes.
You want stability, relative stability. So dovetailing into mortgage rates, the people that are way smarter than I am had estimates that the rates would settle in the middle sixes and probably finish the year out at around 6.5 by the fourth quarter. But we've had several situations this year or days that the rates did already hit that. In fact, some as low as like 6 1/8. So we've already gone below 6.5. So our rates are performing a little bit better than we expected. We also didn't expect the stock market to be as tumultuous as it has been.
Right.
We didn't expect the jobless claims would be higher than expected. The new job creation would be much lower than expected. So the economic data has come in worse. So it's kind of, should we be happy that rates are performing better because it's at what cost? But overall, if we're at 4% unemployment, does that mean 96% of people are still working? I mean, you could argue underemployment and a lot of things that people not looking for jobs anymore. But we know that we still have a very robust job market. So I don't feel that there's a lot of pain among the middle class and the working people of the country. I feel like we're not in a 2008.
Right.
Are we going in that direction? Absolutely not in terms of home values, but could we see elevated unemployment as the year ticks on? I don't know. I mean, I don't think so, but it's something that we should keep an eye on. So that being said, if these kind of trends continue and we see more tumultuous stock market and inflation numbers that are still in line, we're at 3% January 2025. January 2024 was also 3%. So I know the Fed's target 2%. That's an arbitrary number, but that is their goal, which is why you're not seeing a lot of monetary loosening. You're not seeing the Feds bring down the Fed's funds rate. You're just seeing them kind of do a wait and see. So I think, though, that as we know from our interest rate episode, that the Feds do not dictate 30-year mortgages. They follow the T-bill. I think as the stock market, even if this is just a 10% correction that we almost see every year at some point in the year, a lot of times it's in May, sell in May and stay away. I think the montage goes, or the moniker. So if we see that 10%, even if it comes back, it's the volatility that might push investors to quality. They say like a flock to quality. 10-year T-bills are backed by the full faith and security of the U.S. government. So it's a pretty safe investment to be getting 4% on your money with a T-bill. So that's kind of where you see, okay, well, now they're paying 3.75 or 3.8. So it'll be interesting to see. But I actually think that we will settle in lower than what's expected. I think when we average out our 30-year fix this year, it'll be the very low 6s. And I think we'll see high 5s at some point this year. We still haven't seen tariffs yet. We still have many more months of employment data to get through. We still have 9 more months worth of data. So I have to believe that sometime in those 9 months, we're going to see a situation where we've missed inflation numbers, meaning in a good way, where instead of 3, we were coming in at 2.3. Instead of unemployment at 4.1, we're at 4.9. I mean, little things like that will cause a flood to the treasury market, because right now treasury yields are amazing. The Dow ended up in the last 12 months 10.8% higher. So it grew 10.8%. So to have your money in the stock market, you made about 10% a year. But there's a tremendous amount of risk in the stock market, especially if you buy an index fund. And so especially now. So if you look at it, we're at 4.25 for a 10-year T-bill versus all the volatility, which is pretty much guaranteed, and you get paid a couple times a year, versus all the volatility of the stock market where you don't get paid unless you sell. So you have to realize those gains and sell to generate that income. Otherwise, it's just on paper. 10-year T-bills, you get paid. So you can see why they are appealing right now. They're the redheaded stepchild. No offense to the gingers in the audience, but they're not. They're like, who would want a 10-year Treasury note for 4%? It's so boring. My Rivian stock grew 27%, whatever the number is. You hear all those darlings and those stories like that happen. But unless you're really timing those things right, that's not common. And then if you're taking those kind of chances to get a 20% return on your investment, you're probably losing 10% on some other investments too. So there is definitely an appetite for Treasury bills. So that's why I think that the volatility is going to lead to a run on Treasury bills, or at least enough to see high fives at some point this year. I don't know if that'll last forever, but I feel that there's enough vibrations in the ground that I could see it happening.
Interesting.
Yeah, it'd be interesting. Yeah, it'd be cool.
Yeah.
I mean, not cool because there's some untoward effects and there's some other things that we're not even seeing, but it would be nice to feel like the fever of these high rates is broken. Mm-hmm. And that'll really unlock a lot. I think it'll unlock a lot of economic activity. So.
True.
Yeah, it will. Mm-hmm. Mm-hmm. And then that works so well for home builder sentiment. So where is construction? Where are home builders? So we're thinking that we're going to finish about 1.1 million homes this year. So that's up about 13% from last year.
Okay.
And the majority of that will be single family. And most people, we won't really know until the data comes out, but we're expecting it to be more entry-level product. So I think it's going to be 1.1 million homes, and ideally in areas people want to be in and product that people really need. So the non-glamorous entry-level stuff, maybe one tier move up stuff that we need, and it will unlock a lot of.
So that's a national number. We know last year, Las Vegas specifically built around 12,000. What do you think that looks like? Will that, just based on the trends, the number of permits that have been pulled thus far this year, does that?
And the number of available lots, I know that we have about 9,500 available lots that are developed right now. So that's good indication. I think that we'll probably see around the same as we did last year, maybe within 5% of where we were last year. Yeah. So they don't release the data as much as national trends, but I think we'll see that. I think we'll see another 12 to 13,000 units in the ground, which would include multifamily.
Right. Yeah. Right. And that's obviously a best guess, but based on what we're seeing, there isn't anything alarming that would say it should be otherwise. We're right on trend with what we might think in order to meet that same number for the end of the year. Right.
Which I bit my tongue about to say, not literally. There's a lot of factors that could stop that. So if we see, because it's going to lead into the next topic so well, if you see a lot of fear on tariffs and you see a lot of fear on supply chain, and you see a lot of fear around deportations and immigration policy changes, and there's a fear that home values are stagnant. So if the cost of goods goes up tremendously because of tariffs, because of manpower and workforce, that's going to come out of home buyer margins. So it's the same argument over tariffs. Okay, if we add a 12% tariff, how do you know that the consumer is going to pay it? Because ultimately the consumer demand has to be there. And that's true. So homes are a commodity, though, that cannot be moved. It's largely non-fungible. It can't be replicated. You can't just sell your wares somewhere else. If you're an importer to the U.S. and you're avoiding tariffs, you can still charge your same premium and charge a tariff because you might export to other markets. We can't do that in new home construction. We cannot. I can't be an exporter. So I'm stuck with what I have. So if the buyer demand is not there, it's going to take a while for that to work through, because what you're going to have to see is home builders dialing back and saying, well, because the cost to build went up 15 or 20%, which I've lived through in 2020 and 2021. I lived through that, but it was masked because that same year home values went up 27%. And especially the markets that I was building in, that luxury or entry-level luxury market really saw a spike because there were a lot of people that became really asset rich in their stocks, and with maybe they own businesses and had some stimulus, and they got some PPP loans and things that really made them feel very rich. And that market, that $1.2 to $2.5 million market, really went nuts. And the greater market went nuts too, as a whole in Las Vegas, at least in the country.
It did.
But I think that what does that look like when tariffs increase the cost of a home, labor shortages and workforce shortages due to changing immigration policy inflate the price of labor. What does that look like? I don't know. Do these big publicly traded companies still want to put all those homes in the ground just because it's already on the books and they're maybe paying interest on it, or maybe they've committed that for the quarterly numbers. They want to hit their numbers and they'll just allow that. They'll take it instead of 27% margin. Maybe they're at a 21% margin. Or do they hold off and not build 5% of their inventory, 10% of their inventory? We already talked about how many homes are dominated by about 3 builders. How many of that 12,000 will be represented by about 3 builders? Probably half of it just by 3 builders. And there's other publicly traded builders in our market. So if they collectively pull back 10%, that's a big number.
Huge.
Yeah, it's thousands of homes. That's going to be the one thing. That's going to be the variable. But you can see how that will take a minute to work its way through prices. It will ultimately have upward pressure on prices, but it takes a minute to bear it out.
Will that even happen this year? I don't know.
I don't think if they do pull back,
not Q2 or Q3.
No, because deliveries, maybe right. Q4, because it's a 6-month delivery.
Might start to feel
right, because if they've already started, they're not going to. Right. If they've already started, they're not going to dial back just because of tariffs. They're going to finish those homes. Like everything I have in the ground, we're going to finish. It doesn't matter. But it could affect my decisions going forward. So new starts and say how aggressive do I want to be until we get through some of these tariffs? Are these just negotiating tools? Are they tactics? And is it something that I have overpaid for things in supply chain crunches? I did it a lot in 2020 and 2021.
Everybody did. You had to.
You had to. I bought lumber at the absolute peak. I bought an entire lumber package for a house. And it was like, I was probably the one that set that peak. Because then the next day it fell. Not precipitously, but it started its downward trend enough to where I could have said, why don't I just wait a month? But if I had 5 or 6 in the ground, it would have been times 5 or 6 at that stage. So I think that it'll work its way through. Home building is such a long, kind of drawn out process. Maybe it just doesn't. Maybe it irons out all these temporary blips in news. It's not like the stock market where you can literally watch it on CNBC in real time. You can watch your wealth go rise and fall. Home building is just not that way. I've said it before, there's not enough elasticity in the supply and in the demand to have it affected that quickly. So I think it'll iron it out. I'm not really that worried about it. I think that there's enough margin. As a builder, I know there's enough margin, and you're going to want... There are a few businesses that have the kind of margins that we enjoy. So you're going to take 22% margin versus 28% with the hope that maybe home values go up 3% in that same amount of time and kind of offset some of those losses. But I can't predict how a publicly traded company will act. They have boards, they have shareholders. And
they have a national spread. So sometimes they'll do really well in one market and not so well in another. So they can cover those overages or underages in order to make the overall goals.
Exactly. They report quarterly earnings for one company. That's it. I mean, they don't care about Las Vegas. Those division presidents have to report to that, but they're not really... They know.
But as a builder, when you're selling against other builders in our market and you see somebody take a huge, it's the end of their fiscal year. And so you see them take huge incentives or offer something that you're like, well, wow, what is happening there? It's because maybe their market here has done well, but they're trying to make up for a margin in another market that they can then apply here because it's doing well. So
and before that reports, they want it. Right.
Yes. And for us, Trust Home Builders is a local brand. So we just get the Vegas market to use as our par.
Right. Mm-hmm. So I think that's where we're sitting. I mean, end of quarter 4, 2024, we knew there would be threats of tariffs. We kind of knew where the administration was going to lead and set the tone of the country. But I didn't expect it to kind of start to play out this early, where we have hard numbers on tariffs and we have hard dates on when they're supposed to start. It was supposed to start last week and it got pushed to April 2nd. So it'll be very interesting. And a lot of these trade organizations, National Association of Home Builders is one of them, are lobbying the administration to say, look, can you carve this out? Can you carve this out? It'd be funny if we end up with Swiss cheese and only a few things are tariffed, like some of the crap at the dollar store. Maybe we can tariff that stuff. Can we keep lumber? Can we keep lumber off the table and aluminum? So on that topic, this study is, or the prevailing wisdom is that tariffs are going to add around $10,000 to the cost of an average home in material cost. So we build probably to twice the average, right? I would say our average home, trust home builder, is probably 2 times the size of the average home.
Yep.
So I think it'll probably cost us around $20,000 extra material costs. So when I look at my budget for an entire home, that's not enough for me to make decisions over. It just isn't. I can have a utility surprise that's more than that.
Mm-hmm.
So I'm not going to make any changes to my projections and my goals and my projects that are
Interesting.
in the pipeline. There's just no, you can't.
Yeah.
You can't. You're building $30 million of the homes. You're going to make a decision over an extra $250,000, which is what about work out to for all the houses. You're going to make a decision over that.
And then you pivot for something that may or may not.
That may or may not even be right.
Come to fruition.
Exactly. So I just can't. So it's not enough for me to make major changes. So, and it is interesting though. You realize how much of the build industry is reliant on imports. Around 30% of our lumber comes from Canada. We source about 60% domestically. The other 10% we get from Brazil, we get from Mexico, we get just from an assortment of other countries. So if we increase those right now, the Department of Commerce already had a 14.5% tariff on lumber on the second. It's expected to be 39.5% because it's supposed to add another 25% because it's from a different department. And then the Department of Commerce wants to add another, they want to double the 14.5% tariff in addition to the new executive branch tariff. So we could see tariffs as high as 60% on lumber and from Canadian lumber by the end of the year. So that'll be interesting. But we're already at 12%.
Interesting, yeah.
And a lumber package, just to pull back the curtain a little bit, a lumber package on a luxury home, you know what, a good rule of thumb, a lumber package on a house is around $10 a square foot. It's going to depend on ceiling heights and different things. That's not including your trusses, your floor trusses, your roof trusses. But a lumber package is around, so if you build a 4,000 square foot home, it's $40,000. So
that's a great little tidbit.
So if you're a retail, I'm technically a retail lumber buyer because I'm buying from a supplier, several down chains. I'm not buying from the lumber mill.
Right.
Or not importing it directly. So if you think how much of that, because that's just off of the imported cost. So if the imported cost is roughly half of that, usually every person that touches it, it doubles, right? Generally speaking. So that means that $40,000 package may be a $20,000 import, but it already had a 14% tariff on it at that time. So maybe the raw cost was $17,000. So if we add 60% tariff to that, that's around $8,500. Let's call it $9,000. So instead of $40,000, I'm at $9,000. And that's if they went all the way up to 60%. But will there be downward pressure on Canadian lumber prices because of those tariffs? Will domestic lumber go up in value because it will kind of reach a middle ground? So we'll see. Ultimately, the demand has to be there.
When you hear tariffs, but you're not really sure how they apply specifically.
Right.
So you take it all the way back
all the
to
way
that
back.
lumber cost where you have a hard fact. It has to happen in every home that's built. And then how does that change your number right on the front end? So I love that you were able to offer some insight and real numbers. So good fact.
It's hard because everyone thinks lumber is 50% of a house cost. A house costs $1 million. Oh, lumber must be about $500,000 of that. That's just not the case. So it's not really a big, it's one of the biggest line items, but I spend more on tile and flooring. I spend more on cabinetry. So it's not a big, it's big, but it's not, as a percentage of a build cost, it's around 5% of the construction cost.
Interesting.
Just the lumber package.
But you're right.
Trusses, you would think it'd be more. Trusses add another 5% to that. So roughly trusses and lumber is about 10%. So, and trusses obviously are made of lumber. So you would think truss prices are going to go up as well.
Higher percentage is the concrete. And that's such a small. Yeah.
That's right.
Yeah. Concrete, the aluminum, the wire.
Right. And gypsum, a lot of gypsum for drywall is imported. So there's things, but we got to remember now, barring any labor shocks from immigration policy changes, really we're only talking about the materials. So the materials are around half the cost of a home. So even if every single thing were imported and every single thing had a tariff on it, and every single thing, and there were no carve outs, and it would of course it would shrink our margins, but it's not devastating to the industry.
That's good to hear because you don't really know what you're up against in terms of every industry.
It's scary. I think it's scary. A lot of things.
It is scary and it's unknown.
That's
what makes it scary.
Unknown, because no business owner wants any unknown. But that's just why you're a business.
Yeah.
Because if it was simple, everyone would do it. So. True. That's all I have. I do have that the average tree is harvested at 25 years. So I don't know if the
25
audience
years, yeah.
wanted to know that.
They might have.
So-
And if we're all putting up Christmas trees, that could become very important come December. So
Recycle your trees for lumber. So
well, thank you. Yeah, really good
you.
information. And overall, nice to hear that there hasn't been anything too alarming. I mean,
No.
obviously, we don't have a crystal ball. We're not able to predict any of this with 100% accuracy. But as we trend through, and like you said, just to get a temperature on it.
Yeah.
So we're getting a temperature on what is happening this year, the direction that we're going, and we'll do another update as we get into the end of second quarter, third quarter, and then we'll see how the year ends out. But for now, pleased to hear that not too much is changing and
a whole lot of nothing.
not too much news is good
Yeah.
news. So
Very happy.
yeah, good. Well, thanks for joining us on this episode of Trust the Process podcast, and we'll look forward to seeing you next time. Thanks. Bye-bye. Thanks for tuning into the Trust the Process podcast. Make sure to follow us on Spotify to stay in the loop with the latest insights, project updates, and everything in between. See you next time.